Described as the last honest Federal Reserve governor, John Exeter believed by the early 1960s that the Federal Reserve was locking itself into currency expansionism. It could dare not stop. He reportedly would say that the Fed was becoming a prisoner of its own currency stock and debt-based growth, one that risked a credit expansion, reaching total U.S. debt levels far in excess of the country's GDP. He envisioned a major debt crisis ahead and believed the crisis would then turn the economy down to levels not seen since the Great Depression. He also warned that the Fed would one day find itself unable to prevent a wide-scale deflationary depression. Perhaps he could never envision our current viral scapegoat, or how this global economic shutdown would quicken into existence some of his worst economic predictions. But by the late 1950s and early 1960s, our financial system was effectively already devolving into a debt-based, debt-driven economy. To illuminate its growing unstable structure, Exeter devised an upside-down debt pyramid, as this original illustration shows. Within it, the former central banker presented the U.S. debt pyramid and drew attention to the fact that all foreign economies also had debt pyramids too. The structures are always perched in an unstable manner, which Exeter believed was also true for the financial system generally. His original inverted pyramid reads from the top riskiest to the bottom safest haven asset classes as follows. Anyone or anything that can't repay debt. All insolvent thrifts, much of the $1.3 trillion in bank loan debt of third world nations, large segments of the euro-dollar market, junk bonds, state and municipal bonds, commercial paper, bankers' acceptances, bank deposits, CDs, paper currencies, AAA corporate bonds, U.S. Treasury bills, notes, bonds, Federal Reserve cash, gold. The categories with the greatest risk of flat-out default occupy the broadest parts of the pyramid. Lower levels of the upside-down pyramid were less risky debt categories, and risks declined until Treasury bills and cash, resembling our full fiat Federal Reserve notes today. Exeter's original upside-down debt pyramid balanced on the world's existing known quantity of gold then, which at the time was a block representing about 140,000 metric tons. Today that number is now near 200,000 metric tons of gold, which is valued around 11 trillion fiat Federal Reserve notes at the moment. In the illustration, John segregated gold outside the pyramid with a dark, thick, bifurcated line, because bullion represented the only real money in the world and still does today. It has no liability against it, and it's the only asset refuge that cannot default to worthlessness nor be arbitrarily devalued in a financial crisis. In the Exeter scenario, at some point the financial world at large would lose faith in the financial system and move down the financial pyramid to cash and then outside the pyramid entirely, into gold bullion and perhaps other perceived safe haven assets. So he envisioned the price of gold would be rising against all competing currencies as the value of debts and other securities declined as the deflationary depression began bankrupting more than the Federal Reserve could ever attempt to save. On this channel, we've partially and recently covered how this process is already underway globally in all fiat currencies. But today, we're going to remind you that perhaps the sharpest investor and asset class holders in the world are signaling with the votes of their fiat currency capital that the deflationary beatdown is going to worsen dead ahead. Hello, this is James Anderson of SD Bullion, and we're here to give you a brief bullion market update. Backing up last week's points about NIRP coming to the U.S. government debt markets, negative interest rate policies, the following 3 tweets from macroeconomic financial analyst Raoul Powell regarding increasing and likely further negative interest rates upcoming. We begin with tweet 1, which reads, amongst the bullish sentiment, UK 2-year gilt yields slumped to negative for the first time in several hundred years of history. I listen to the bond markets, not the stock market. They understand the economy. They know something. And 2-year US rates hit an all-time low, 10 bips. They're going negative too soon. The bond markets are whispering deflation and insolvency. Are you listening? Or are you going to wait for the equity market to shout it too late? And finally, he tweeted, "The deadly formula, debt plus deflation, equals a ticket to bankruptcy." This final third tweet of the thread essentially describes the deflationary default doom loop, which, if large enough, can cause a chain reaction of cascading defaults in an economy. It's basically a very nasty situation that can ultimately lead to a run on the financial system, when increasingly investors and capital began asking in larger numbers for their capital back across asset class spectrum. The upside-down pyramid we started this video with, as payments go unmade, it begins putting pressure down the financial chain. And write-downs and bankruptcies and bills that go unpaid, they can and often do beget more write-downs, bills that don't get paid, and larger bankruptcies to follow. And it takes time, typically, for this type of thing to work through a system. It takes months, sometimes almost a year, for this kind of stuff to come about. But when it does, it comes as an avalanche, typically. And even though the financial cheerleaders, they're going to continue spinning the damning data as something positive, do not be fooled.
Mrs. Secretary, thanks for joining us this morning. I want to get right to the news. 2.4 million new jobless claims of unemployment this morning. Several Senate Republicans said yesterday they want to see some action now on the next relief package. Is another package necessary? And if so, when?
We're going to carefully review the next few weeks. I think there is a strong likelihood we will need another bill, but we just have $3 trillion we're pumping into the economy, and we're going to step back for a few weeks and think very clearly how we need to spend more money and if we need to do that.
So this is just a quick review of a bit of what we do know thus far in terms of bailouts ongoing. The private Federal Reserve started bailing out the overnight repo lending market in September 2019, and that was a sure sign something was rotten in New Amsterdam and beyond. And that is a story we documented on this channel well before this viral crisis set in. The Federal Reserve has now amassed over $7 trillion on their balance sheet, and some are calling for this balance sheet to hit $12 trillion in the not too distant near future. In sheer volumes, we're already putting the rest of the world's central bank bailouts in the dust. It certainly helps that the fiat Federal Reserve note still remains the financial plumbing's main unit of account. Our full fiat US dollar represents about 60% of FX trading and currency spent around the world in notional amounts still. And we just heard the US Treasury Secretary, whose office recently combined with the private Federal Reserve in this bailout orgy, that more stimulus is coming. Combined already, what we know is that the U.S. monetary and fiscal authorities have committed to injecting over 44% of our annual GDP into the financial markets and economy. And by their words and current U.S. congressional actions, well more fiscal stimulus is on the way. Eventually, we should also expect trillions in infrastructure spending, as well as lump sum checks or monthly checks to be sent to U.S. taxpayers to cover but a likely fraction of their many losses ongoing from this viral crisis. And even through our derivative price suppression, price retardation markets, gold is still sniffing all this out. Look at the RSI, or Relative Strength Index, for gold bull markets. Historically, through this full fiat currency era, at the gold bull markets, when the technical level clears 70 on this chart. We shall see in the coming years how hard and high another aqua-colored bull run might look, as Exeter Pyramid proves its accuracy in debt deflations and perhaps too with further financial and even a currency crisis to come. And for all you patient silver bulls out there, mind the gap on this 1950 to 2020 performance chart. The data starts from just following the last time we had a massive US debt overhang coming out of World War II. And that gap is the outperformance that silver typically runs through during the mania phases of bullion bull markets. And those years are likely later this decade and perhaps even into the next, given all the various things we just covered. That is all for this week. Take good care of yourself and your loved ones out there. If you enjoyed this content, be sure to give our video a thumbs up. To keep getting bullion-related news and industry insights, be sure to subscribe to our channel. Finally, hit that alert button so you know when we publish fresh content. Give us your thoughts in the comments below. Let us know what you think and which topics you want to hear more about.